Good afternoon. My name's Tom Hickey. I'm the Managing Director of Kenmare Resources. Kenmare is a listed company that operates the Moma titanium dioxide mineral sands mine in Mozambique. We've actually been in Mozambique for nearly 40 years. We've been in production for almost 20 years. And we have a multi-decade project which will be in production probably for the next 80 or 90 years at least. Kenmare is producing ilmenite, zircon and rutile, which are all used in day-to-day applications and very related to global economic growth. And we are probably the third biggest producer of these products worldwide. So we're really meaningful in the context of the industry that we work in.
Tom, good to meet you. Thanks for coming on the show. Look, we've not met or spoken before, so maybe we should kick off and try and understand a little bit about you. So where have you been? What have you done prior to this?
Well, for my sins, I'm an accountant. And for the last 25 years or so, I've worked in various natural resources projects, mostly oil and gas actually, but always with a focus on Africa. I was CFO of Tullow Oil for almost 9 years between 2000 and 2009, during which time Tullow grew from being a kind of a 200 million market cap to a FTSE 100 company. Sadly, it's reversed course since then and hasn't performed that well. But it was a great learning experience. We did deals, we raised capital, we made huge discoveries in Ghana and Uganda. I was exposed to the whole natural resources investment cycle, lots of different countries, lots of different administrations, lots of different outlooks. And I think that kind of gave me the passion for the industry and the passion for Africa. And I think that's something that once you have it, it never leaves you. So, in the intervening period, I worked with a number of other natural resources businesses, but I joined Kenmare just under 3 years ago, initially as CFO and became MD in August last year.
Right, okay, and then tell me a little bit about the kind of operational team around you. What's their experience?
We have actually a really experienced team. We've all worked for many years in mineral sands or mining businesses. Ben Baxter, our Chief Operating Officer, worked in South Africa with Rio Tinto, in Madagascar with another Rio Tinto enterprise, has been with Kenmare for nearly 11 years. And Ben is really responsible for the day-to-day operation of the mine, our investments, our performance, the team, our communicating our purpose and our values, and of course keeping everybody safe. And more recently, when I stepped up from CFO to Managing Director, I was replaced by a guy called James McCulloch, who's also a 15-year Rio Tinto veteran, was previously head of planning and strategy in Rio Tinto. And before that was an equity market analyst who covered Kenmare. So he's actually known Kenmare for many, many years, but only joined us about 8 to 10 weeks ago. So we've got a nice combination of people who have outside experience in other resources, but also perhaps a fresh perspective on Kenmare.
Okay, and let's talk a little bit about the jurisdiction. Mozambique was obviously known to some, but not many. In terms of operational activity, that he in country or country manager, he kind of manages things operationally, and he does the kind of government liaison component.
So, like Mozambique is a very big country, and actually our country manager is hundreds of kilometers from the mine. So we really have two centers of operation. Our mine is in Nampula province, which is in the northeast of Mozambique. We employ about 1,700 people. 97% of them are Mozambican. We've really made an effort to work with the community, to work with nationals, and to try and really be in the area in which we operate and contribute to the community, because we're going to be there for a long time. That our general manager is actually a Mozambican, a guy called Higino Jamis, who's been with us 10, 11 years. And I think it's a great example of the progress that's possible in the business, that a Mozambique can rise through the ranks, which also includes some expats, and thrive and lead. And I think that was really well valued by our employees, but also by the government and the authorities in the region who see what's possible in a career with a company like Kenmare. And then in Maputo, we have Garrett Clifton, our country manager, who's been in Mozambique 30 years, been with Kenmare 20 years, and knows all the stakeholders, government, NGOs, civil society participants, and that really helps us just to manage all the relationships that we have in country.
Right, and so tell me about what's actually happening in the country in terms of engagement with the government, President Chapo, etc. I know your discussion with the implementation agreement extensions, etc. How's that all progressing?
Sure. Well, Kenmare was one of the first companies in Mozambique that kind of developed investment agreements, over 20 years ago. And our agreements, our first major agreement came up for renewal during 2024, and the discussions have extended into 2025. And look, we acknowledged we got a good deal back in 2004, but equally we exceeded every promise we made. We invested more, we produced more, we employ more, we paid more taxes. We've conducted excellent social programs that have really made a difference to the communities around the mine. Under our agreements, we have the entitlement to renew at the same terms. But 2024 is not the same as 2004. There are other investors now in Mozambique. There are other pressures on the government. I think it's important that the government gets a slightly better return from the project. So we've made a proposal to government that kind of highlights that we could make an additional contribution from the project to the country. It highlights the investments we're planning to make over the next 20 years. And, I was fortunate enough to go and discuss that and a lot more with President Chapo about 4 weeks ago. Because, if President Chapo follows precedent, he could be president for 10 years. So in reality, the first thing you want to do is alert him or remind him, because he knew well, of what Kenmare has achieved, how we behave, the fact that we regard ourselves as, kind of textbook natural resources company that contributes actively to the country and is very transparent in what we do. And all that we've achieved in terms of social investment and an improvement of the lives of the community, and what we can do in the next 20 years. But of course, that won't happen without the agreement. So we think that the president is a good listener. He's quite commercial, quite pragmatic, and he understands that foreign direct investment will be vital to Mozambique's expansion and extension over the next number of years, and it will be central to the achievement of his vision and his mandate for his presidency. And so I think we left certainly with an assurance that the president will be a credible counterparty for us, that he understands the importance to us of this agreement and the importance to us of getting it resolved quickly. And frankly, that there are more than just our eyes on the agreement, that many other investors and stakeholders are looking at it and hoping to see a resolution soon. So it was a good meeting, which was just as well, because he's about 6'10", and I didn't want to fight him.
Well, I think both sides got to be pragmatic in this, but what does it do in the short term to you in terms of that your current kind of fiscal regime, your ability to does it affect things like project permits?
It hasn't changed anything. We continue to operate in the normal course, under the old terms until we conclude this agreement. All that will do will effectively just change the rate of royalty we pay on what we produce day to day in Mozambique. It doesn't affect our license to mine. It doesn't affect any of our employees. It's something that we obviously are focused on resolving as soon as we possibly can.
Right. Okay. So look, and pardon me for sweeping generalizations, but people look at Africa and sometimes I wonder if they think it's one country. But you look at what else is happening across in West Africa, a little bit northwest of you. You've got situations where there's kind of repatriation of physical gold. You've got repatriation of projects, quite frankly. So these conversations are really important to get resolved quite quickly. You started last year, you're still talking this year. When does this get resolved?
Well, I think there's been the small matter of a presidential election and a change of cabinet during that time, and that presidential election certainly came with a degree of turbulence and social unrest, which has now thankfully settled. So look, Mozambique has been a good partner to Kenmare. The civil servants, senior, permanent government ministers that we operate have been thoughtful, commercial, transparent, and consistent. And we don't expect them to be any different. But equally, we expect them to protect their interests as we will ours. I guess a slight difference, versus some of the other territories and initiatives that you mentioned, in that, one of the key drivers of success for Mozambique in the next 10, 15, 20 years will be its natural resources, and in particular the huge gas discoveries that are offshore the north of the country, with Total and ExxonMobil and ENI, and a number of those investments are still waiting to commence. Multi-billions of dollars will need to go in, and the government's balance of payments, the availability of foreign currency, the level of employment, the ability to attract other foreign investors, all of those things will be transformed by that. So getting the most out of the country's natural resources on a sustainable long-term basis is absolutely critical. And I think the administration understands that, and understands that the early entrants, and Kenmare certainly was one, are a fundamental part of that. And also, maybe in contrast to some other territories that you see in Africa, they understand that you don't just need the huge companies. Not every asset is huge. You need big companies, small companies, medium-sized companies, because that's the range of oil or gas fields, and mineral resource deposits that you'll have as well. And I think Mozambique is very conscious of that. And Mozambique is very much on the kind of ascendancy in terms of exploiting its natural resources. So it will need a lot of capital to come into the country over the next number of years. And of course, to attract that, it needs a stable regime.
Right. And are there other stakeholders that you can expect support from locally or nationally?
Yeah, I mean, we've had great support from the Irish ambassador, the EU ambassador, the UK High Commissioner. I mean, the EU, via the companies I mentioned earlier, is the biggest investor in Mozambique Inc. And the diplomatic community has been certainly to the forefront of helping us give a clear message, give a consistent message, and build on that. And maybe one other stakeholder to highlight is our biggest shareholder is the Oman Investment Authority. They have 17% at Kenmare. They've been in the company for not far off 10 years now. Oman itself has many investment opportunities in Africa and in Mozambique. And I suppose how Mozambique treats its historic investors and their other interests will be a key determinant of how they apply future capital. So I think it's always great when you have, parties that are interested but not directly benefiting from your project, advocating for it. And I think we've been fortunate with that. And look, I think that's partly because Kenmare has been a good corporate citizen. We've been voted the most transparent company in Mozambique for the last 4 or 5 years. And even the government itself acknowledges we're the type of company that they want to have in the country, who take raw materials out of the ground and export finished products, and pay all the duties and costs associated with that.
And they've got no capability of trying to kind of capture more of the value further downstream. They're not interested in that.
It certainly wouldn't be our game. It's not an area we have skills in. But we'd be delighted. We'd be delighted if somebody wanted to build a pigment plant or a synthetic rutile plant in Mozambique. We would be delighted to supply it. And I think it would be further evidence of our commitment to the country. So, as long as it's at the same terms as if we'd sell to anybody else, I think that would be a great mark of progress.
Okay. And obviously, lots of, they should do this and they should do that. But is there a kind of plan B? Is there a kind of minimal viable product for you if conversations don't go the way you want?
Well, on the implementation agreement, if conversations on the implementation agreement don't resolve themselves, I suppose there are protections within the contract, i.e. we go into a dispute. But as I said earlier, it doesn't stop us mining. It doesn't stop us producing and selling. All it does, it would change the fiscal terms under which we do it, and they'd be less advantageous. And, clearly we wouldn't make as good a return on our investments. But I would be very surprised and extremely disappointed if that were the outcome. And I suspect the government would be too, because they have no desire to be in dispute with us.
Do you think timing might be on your side in the sense that there's currently obviously oversupplied titanium feedstock market, with the rise of Chinese and West African concentrates. So does that help you? Are you getting any sympathy from the in these conversations?
It's not. I think expecting governments to have sympathy for private companies is probably a little bit Pollyanna-ish. They have to protect their interests. I think what it does is it helps. Maybe what has been more persuasive and more influential with the government is the tangible visibility of our investments. We're currently spending, over last year, this year, and next year, or the next couple of years, over $300 million to migrate one of our biggest mining plants to our biggest ore body, and that ore body is 70% of our reserves. All our plants will end up there. The future of Kenmare will be dictated by this ore body called Nataka. And the government have seen, even today, there are 2 high-powered new dredges sitting offshore Mozambique that cost $66 million that the government can see as a tangible evidence of our investment. And if you look at our website in the media gallery, you'll see videos from and images right up to about 10 days ago of exactly what's going on the ground. So they can see that we're investing for the future. They know that we're applying our capital to the next 10, 20, 30 years, and they know that we can't do that without an agreement. So I think that the sympathy, if you'll call it that, comes more from realizing that, when we make a promise, we keep it. We did that with the last set of commitments we made, and we do it with the next set of commitments we made, and we're investing, not far off our market cap to continue to employ 1,700 people in a region with very little other employment. So I think they realize that Kenmare's successful future is important not just to us and our stakeholders, but to the country as well. And I suspect that's something that will lead or hopefully accelerate the resolution of the discussions.
Okay, well, let's get into that kind of capital allocation a little bit more. Obviously, I just going to reference the fact there's an oversupply of titanium feedstock in the market at the moment and on several levels. Can you sort of elaborate on your kind of your rationale behind the revised long-term pricing assumptions that you've made, and how is that impacting some of these capital allocations that you're talking about? Because some of them will have been long time planning, and others which maybe are you changing your decisions about how you allocate capital going forward?
Titanium dioxide and mineral sands mining is a long-term capital intensive business, and we've invested over $1 billion in the last 20 years to ensure that we can do it cost effectively at low operating cost, and be in the low point of the revenue to cost curve, so that we will survive the cycles that are always there in terms of resource pricing. But I think that when we think about capital allocation, we think really about how best can we exploit the resource that we have. How best can we have a mix between those capital intensive operations which have been perhaps the way of the past, and we see around us, and you mentioned the concentrate producers, smaller, more nimble, perhaps more transient producers who are attracted in by high prices a number of years ago and perhaps will exit, should prices continue to stay where they are now, and we're probably even seeing some of that happening. And I suppose the trick for us is to a degree have a foot in both camps. Be able to tolerate periods when prices are lower and invest through them. Be able to mine all the resources that we have, as opposed to just the best sands, which I think smaller artisanal operators can't mine the totality of a reserve. And to be able to continue to maintain our employment and maintain our commitments to the country while we do that. So I suppose that what's the complicating factors in the last year or year and a half have been probably a response to high pricing in 21, 22, and to a lesser extent 23, where new parties enter the market. They produce, perhaps in Mozambique, maybe exactly the same as we do in terms of volume, and that is creating a transient oversupply. Now, it's a very modest oversupply, and what we're not seeing is big new projects like Kenmare's, big conventional Western, if I'll call it that, projects, of multiple hundreds of millions of dollars to develop long-term, multi-decade resources. So, certainly we've had, if I'll call it the irritation or the introduction of smaller sources of supply and concentrate and sending materials to China where there's a massive processing overcapacity. But certainly if I look back at 2011, 2012, when something similar happened following a period of high pricing, at that time with Vietnamese and Indonesian producers, it disappeared as quickly as it emerged. So, I think we've always said we see a supply gap emerging over the next number of years, maybe a little later, but it's still there. And to be honest, that's reflected in what we hear from our customers. We spoke to one customer a couple of months ago who said, 7 years ago I had 8 suppliers, now I have 2. So, all supply is not the same. Slightly Orwellian of me, but all supply is not the same. And certainly Kenmare, because of its consistency, because of its quality, because of its longevity, is probably a preferred supplier to a lot of the customers we work with. And most of the customers we've worked with for nearly 20 years.
So tell me about that. So you've got a customer that said we had 7 or 8 suppliers, now we've got 2. How does that explain that?
Well, for example, over the last 12, 24 months, there's been 2 mines that would have been developed over the last 10, 12 years that have ceased production. They've just got to the end of their natural lives. Other companies have been consolidated into larger businesses. So it's just natural consolidation plus a lack of new investment in new supply, plus a lot of volume going into China, where the processing capacity has been developed quite aggressively in the last number of years. So it's a little bit of a change in the shape of the market, but I suppose it benefits us through our consistency and through the fact that we're not integrated with any vertically in the value chain.
Okay, so you're saying basically the problem the solution for low prices is low prices. We're not going to see new entrants coming in here, and maybe we get to.
You sound exactly like my CFO.
Right.
Okay. The best cure for low prices is low prices. The best cure for high prices is high prices.
Right. Okay. So this kind of titanium concentrate ilmenite oversupply, titanium dioxide oversupply sponge. Well, I think it's a bit more around grade issues, but how you talk about working through cycles and so forth, but so when does this kind of resolve itself? People are panic selling in some cases just to kind of stay relevant, but that can't last forever.
No, and we haven't done any of that. I mean, even throughout this, we'll call it slight oversupply cycle, and I don't want to dwell on it too much because of the different segments of the market, but like we can sell everything we produce, because of the quality of our project and because of the availability of our product. And so, I think that it's more about the fact that pricing is slightly lower, and we probably expect to stay a little bit lower for longer as a consequence of this source of supply. We still forecast a recovery. Independent commentators like TZMI and TipMC still forecast a recovery, maybe just a little later.
And is there any sort of hope in this? I mean, zircon. Is a demand for and resilience for high grade zircon still there?
The demand is there. The demand for our zircon is there. The demand for our ilmenite is there. And look, even at these slightly lower prices, we're still making good margins. We made a 40% EBITDA margin last year. That's the benefit of investing for efficiency throughout the cycle. Even as prices fall, you will make good margins. I mean, we maybe not the 60% EBITDA margin we made in 2022, but more than enough to cover our reinvestment obligations and I suppose to give confidence to our lenders and to pay dividends to our shareholders.
Right. And in terms of where's the recovery going to come from? Where's the demand going to come from? So I heard some politician go, we don't have a tax problem. We don't have a spending problem. We have a tax problem. Yeah. So what here is going to be the kind of cure all for this sector? And when do you think that's coming? And where's it coming from?
I think it will happen. The next phase of price growth, whenever it emerges, will have a number of drivers. One, I would suspect some degree of stability and clarity on what's happening in the Chinese economy. And while we have seen some, perhaps nascent green shoots or positivity emerging through CPI data and, other metals in the last couple of weeks, people have got poor a number of times over the last few years trying to call the recovery in China. So maybe it's a little early to be thinking about that. Secondly, to the extent that, and hopefully for lots of reasons, there's reconstruction in Ukraine or Gaza or anywhere else, we will see that stimulate demand. Thirdly, I think the natural underlying economic growth for the last 30, 40 years, TiO2 demand, and to a lesser extent pricing, has been driven by global GDP growth. And as we see that return, and perhaps even as we see maybe slower than some might like, reductions in interest rates, that will stimulate investment activity too. Look, clearly tariffs and the uncertainty that's created and the noise that's created in the market probably hasn't helped. But I think that will work its way through. And, I suppose it's important to remember that what we produce is a critical mineral on most people's lists, so won't be impacted. But, the adjustment or amendment of investment plans is probably what impacts us.
But it doesn't matter whether it's China or ex-China. Construction, automotive, coatings, heavy inventories, summer, lull, competition and concentrates. It doesn't matter where you are. These things are here at the moment. So, and you tell me different. Do you think there are any kind of jurisdictions that will pick up sooner than others? Well, even if you can't tell what's going on in China.
I talked about tariffs earlier, and actually the EU imposed 38-39% tariffs on Chinese pigment during 2024, and we have seen that lead to improved utilizations, improved margins, and improved demand from our Western customers. Similarly, we signed a couple of new sales contracts this year, and our sales contracts are generally long-term sales contracts with customers in the Middle East. So people are investing, and people are coming to us looking for supply, and probably maybe even more than we can supply at the moment. But so we're seeing on the Kenmare side more than enough demand for volume. We're just kind of preparing ourselves or trying to position ourselves for a recovery in price. And we initially thought that might emerge maybe late this year. I think, as I said, that's probably pushed out a little bit, but certainly not forever.
So in terms of, look, you've been around a while, been at it a while, it's 40 years and 20 years in production, and you're used to the cycles, or the company's used to the cycle, and I hope that knowledge has sort of stayed with the management team. But is there any part of you that feels you need to be nimble and agile in markets like this? Do you need to change the way that you plan? Not a survival thing, because you say you're making good margin here, but for growth's sake.
Well, look, I think we're investing for growth. We produce about 1 million tons of ilmenite at the moment, and that should rise up to 1.2 million tons over the next few years as we execute our current capital programs. I think, and we market quite an opaque commodity. You can't hedge it, you can't sell it forward. There's no active market in like oil or like gold or daily reference price. But actually, that's a benefit to us. It allows our marketing team to orient Kenmare towards the segments of the market where there's most value or most defensive quality. So we've oriented ourselves perhaps away more from the lower value, more competitive sulfate ilmenite area, more into titanium metal or secondary processing, which, although it's less than 10% of the uses of titanium dioxide worldwide, is probably closer to 20% of our sales. So we are trying to form partnerships that will have duration with customers who value our quality and availability, and I suppose perhaps even emerging over the last couple of years, but not irrelevant. The fact that we don't use any poisonous chemicals, 95% of our energy comes from renewable sources in Mozambique, means that our products have a very low carbon footprint, and people are thinking of their Scope 2 or Scope 3 emissions. It's an important input to that if that's something they value, and that is an increasing dialogue with some of our customers as well.
Okay, and that you thought you were coming on here to chat about, which is what's going on operationally, which is talk to me about. You've referenced some of it, obviously, with these dredgers coming through, but in terms of upgrades, in terms of the downtime required to be able, and what the offset operationally for these upgrades. I mean, can you tell me what's sort of happening on the ground?
Sure. I mean, first of all, if you look at our website and you look at our media gallery and you look at the videos, you can see exactly what's happening on the ground almost week by week. But in short, I mentioned earlier, Nataka is 70% of our reserves. All our mining plants will end up there. They'll end their lives there, and they'll be there for decades to come. Our biggest mining plant, WCPA, which is about 50% of our production, needs some upgrade to enable it to deal with a slightly more resilient or trickier ore to mine at Nataka. We've tested it, we know we can deal with it, but we need to modify WCPA to do that. So the investment we're doing at the moment is 2 new dredgers to mine more material, much more quickly, more efficiently, and to always fit our plant. And the processing or pre-processing capacity on WCPA to remove what's called slimes, which are microscopic particles which can cause problems in the processing and recovery cycle. And I mean, that's the key purpose of the investment we're undertaking. There'll be infrastructure, there'll be electrical installations, there'll be a tailings storage facility, there'll be lots of other things, but the key objective is to ensure that when our biggest plant gets to Nataka, it can mine there effectively, it can, and we can fill our processing plant, which has always been a constraint. Kenmare has a plant, mineral separation plant that could probably handle 1.2 million tons a year. We filled it 3 months, 4 months, 5 months, but never 12 months in a row, never 24/7, 365. Mining enough material has always been the constraint, and we're hoping to remove that as a constraint. I mean, that would probably cause us to find other bottlenecks, and then we'll deal with those other bottlenecks. But the capital that we're allocating at the moment is to maintain and extend our current level of operation, to expand a little bit. And it's the last really big investment Kenmare has to make. So in 2-3 years' time, we'll be throwing off very, very significant free cash flow. We can then think what we want to do with that. Do we want to change our dividend payout ratio? Do we want to do more buybacks? Are there other opportunities, for investment in Mozambique or elsewhere that make sense? And look, we clearly have to have a dialogue with shareholders about that. But for the next 2 years, operations is strategy. Getting the Nataka move right, getting the money, getting it is done on time and within our capex guidance, which thankfully we've managed to do to date, and getting it done safely. They're all the vital objectives.
So obviously, like with this transition, the objective is to keep the guidance running smooth, or keep the guidance on track, and and deliver. Is there any opportunity to actually sort of maybe delight the market? Are you seeing opportunities to increase the grade or higher throughput or anything like that?
Well, as I said, one of the core purposes of the move is to increase our production by
But
not
now,
far off 20% over the next number of years. I think that the delight of the market will likely be arising from what we will see as an emergent recovery in pricing and the consistent ability to deliver on expectations.
oh no, you'll be able to double dip at that point. But I'm talking about the kind of short term. Is there going to be a dip in production as a result of all of this distraction?
When WCPA moves to Nataka, it will be moving through a less mineralized zone, and that creates a slightly lower level of production. But we can address that, or we can mitigate that through some new investments we've made in much smaller mining plants. I talked earlier about some of the more artisanal projects that are around us in Mozambique, and look, we'd be stupid if we didn't learn from that approach. And in the last couple of months, we've installed a new, what we call selective mining operation, which is a small, mobile, nimble, very flexible plant that can mine effectively either smaller pockets of ore that the bigger plants can't manage, or that can supplement existing production during times when it might be reduced, as we say, by the transition to Nataka. And just by way of context, our smallest principal mining plant, WCPC, cost us about $45 million in 2019, and that's 500 tons an hour. Our first SMO, which mines 300 tons an hour at least, cost us $6 million. So it's very capital efficient. Won't last as long. Probably will be the last 10-15% of our production, but it enables us to smooth, as you say, some of the ups and downs of grade during the transition to Nataka, and it enables us to rapidly meet emerging demand if and when we see it.
Right. So this SMO, you've got 1 and 2 going on there. In terms of some of these other potential periphery zones, as it were, have you done much work on that? Have you got a certain sense of maybe what the opportunity could be?
Well, look, in Nataka, we've done very extensive work. We've done, pre-feasibility and feasibility studies, and, there's no way our board would sign off a $340 million investment without having some understanding of exactly what it meant. We also have another ore zone about 70 kilometers to the north called Congolone, which in time perhaps could be a further expansion opportunity and could get us up significantly higher again. Now, that will only happen when the market is ready, when shareholders are ready, when the capital is available, when it's a very advantageous project. So, I think we're very focused on today's knitting and today's task and today's investment, and I think successfully delivering today's investment gives us the license to do tomorrow. And that's the way certainly myself and Ben and James as the leadership team are thinking about it. As I said earlier, the next 3 months are absolutely vital in this, and this project is being de-risked on a daily basis. We've already spent a lot of the capital. We already have a lot of risk behind us. The dredges are already built and paid for and sitting offshore Mozambique. The next 3 months, and we'll give regular updates, the next 3 months will be the important delivery. And once we get through that, I think that there's a chance to reintroduce the company to people, because effectively we'll be a new company, post capex, well positioned for the future and with significant emergent free cash flow over the coming years.
Right. Okay. Obviously, net debt around 85 million at the moment, and forecast a peak in first half next year. How does it affect you sort of managing any covenants that are in place?
It's interesting, actually. As you may have seen, we were subject to a bid approach in the last couple of months, and while that receded a number of weeks ago, I think one of the things that led us to understand as we talked to the consortium was the financial capacity or the debt capacity that our own banks recognise in our assets, which is significantly greater than we have now. And actually, to be honest, it's inherent in the covenants we have. I mean, the covenants we have in our bank facilities are not in any way challenging, based on our current level of operation. I think we have the ability to continue to invest, to maintain dividend payments, and to keep our balance sheet in good order throughout this investment cycle.
And do you feel, obviously, with that big chunk of capex coming down the line, worth 350 million or so, and the working capital, etc. Do you feel that you need to kind of balance out that dividend commitment for now, or do you think people would understand if that kind of got adjusted?
Well, look, I think dividend payouts generally move based on performance of the business, and we have a dividend policy, and maybe occasionally we would divert from that policy in a positive way and pay more if we feel that the signs are good. But I think we've just announced today, our interim dividend would be between 8 and 12 cents per share. That certainly sets us up to make a further decision in March next year based on circumstances at that time. And I think one of the things that the bid approach did enable us to do over the last few months was talk a lot to our shareholders. You can get a lot of insight from them on how they see the company, how they see value, what their expectations are, what their investment horizons are, and also how important income is to them. And not just income for them as shareholders into their funds, but also dividend payments as an indication of capital discipline within the business and your recognition that not everything can go back into the ground, or not everything should go back into the ground.
Yeah, but at the same time, things like we talked about it today in terms of ilmenite and zircon prices affect free cash flow, in the business. So you're going to have to make certain calls. And so I'm interested in what they did tell you. You said you learned stuff from these conversations, saying this, unsolicited bid. What did they tell you?
We also did a shareholder perception study last year, and I think what our shareholders want us to do is, successfully and safely deliver our capital programs. Focus firstly on today's operations and operation delivery, as opposed to getting more ambitious and expansive and thinking about growth. Maintain, a conservative gearing profile and effectively not to risk the balance sheet, but also to continue to pay dividends during the investment cycle to demonstrate that we have that capacity, and I suppose to continue to emphasize the fact that we do make good margins at all points in the cycle. And look, I think I also have to be conscious that I'm new in this seat, so I have a dialogue with shareholders over the next number of years to help communicate to them our vision for the next number of years within the business, and hopefully recruit them to that vision and get them to support it. So the messages from shareholders were few, and they were simple, but they were very clear.
Right. And how did they take the 125 million impairment? What did they think that was a good move?
Look, I think the impairment process is a very mechanistic process. You prepare a model every year. You're on the same basis, using the same set of internal and external price forecasts. The auditors using a weighted average cost of capital that is tested by our auditors, and depending on what that spits out, you either have no impairment or you take an impairment. And I think it's more a symbol of the fact that, as I said earlier, Kenmare has invested over $1 billion in Moma. We don't trade anywhere near that. So, when those values are on the balance sheet, I suppose it shows a mismatch between, the stock market price of the company and the capital that we've invested in it. And I suppose maybe to a degree that's the origin of some of the approach that we had as well. The approach that we had shines a light on fundamental value. So I think once impairments, I prefer not to have had one, of course. But I think it's non-cash. It doesn't impact on any of our investment plans or dividend payment plans or bank covenants. And we look through it and we determine our dividend next year. So I think once we explain it to shareholders, they'll get it. And perhaps in a couple of years' time, we look back on this and see that it was the low point of the price cycle, and that it actually represented a turning point where, post capex, we should be well set for good performance.
Yeah, like saying, no one wants to do it, but you do it for all the right reasons. Can you just maybe share some of the assumptions behind the logic, and possibly even, is there any scenario that you see where some of that could be reversed?
I mean, the accounting rules permit you to reverse it, and nobody wants to hear from me on the accounting rules surrounding impairment. That would be an enjoyable half hour. But I think, to be honest, we looked, the impairment goes against our property, plant and equipment. And when we looked into the costs that are capitalized there's quite a few costs from pre-2010, capitalized interest, startup losses, lots of things that aren't actually part of the day-to-day fabric of the business. So, I think the impairment, again, while not ideal, doesn't really reflect any diminution in capacity or value of the facilities we have at Moma. I think once we can persuade shareholders of that, and I think what the price reaction today has been a little bit off, but I think it's certainly not been surprising given the news. I think that we'll have the chance to go out with our interim results in 4 weeks' time and sit in front of our holders and talk them through exactly what the elements and assumptions were. And for anybody who cares to read it, our annual report last year has 2 pages on the various assumptions and sensitivities around impairment.
Okay, and just in terms, look, and I'm sure you do this at every board meeting, but can you just talk about maybe any kind of further cost reduction opportunities within processing or logistics that may help whilst this kind of weaker pricing environment is here?
I think what we have done, we have a couple of it's either cost reduction or margin enhancement. One of the things we've done this year is, in addition to the SMOs, which, as I said, give us this flexibility and swing capacity, we've actually, I go back to our marketing team, following discussion with a number of our customers in China who have lots of processing capacity, identified that we actually have waste streams, waste materials that still have ilmenite, that still have zircon, that still have rutile in them. Now, it doesn't pay us to put them through our facilities again and again and again, but certainly some of our Chinese customers have the ability to do that and to recover valuable material from it. So actually, we're selling a new product called zircon, which effectively is a waste stream for Kenmare, to our customers, and they're paying value for it, and that's pure margin enhancement. Of course, we're looking at optimizing our diesel consumption. We're looking at being efficient on our electricity consumption. We're looking at whether our maintenance cycles can be better. But like that kind of value planning or that kind of restless innovation, every company has to have that all the time, right? So that's just routine. But yes, you're right. I mean, our board consistently charge us with making sure that we're in the right point of the kind of operating cost cycle and making sure that we're able to survive and thrive when perhaps others are having more difficulty.
Right. Okay. And just if you don't mind, just with that RX offer, you've obviously assessed that and went, that significantly undervalues us. What were you looking for? Because there's a kind of rule which is you're worth what the market is prepared to pay, right? But if you're not only if you're under pressure to sell, but you're not under pressure to sell. So would you consider another offer?
Well, we weren't running a sales process. We're not under pressure to sell. And I think a lot of our shareholders, many of them have been with the company for 8-10 years. They have a long-term investment horizon. They saw the bid as kind of opportunistic at a low point in the price cycle, at a point when you mentioned the implementation agreement that hadn't been concluded, at a point when we were in the middle of a CapEx program. And I think the feedback we got from those shareholders was, look, we wouldn't rule out a bid for Kenmare, and you're not stupid to entertain at this price level. But, we'd be, if the alternative is lower than the £5.30 they came at, we'd be happier to wait 2, 3, 4, 5 years to see full value and proper value and to see the NPV of the long-term cash flows without CapEx reflected in any bid. And look, I think our shareholder register is quite concentrated. The top 10 shareholders are 70% of the register. So, we'll always have a good dialogue with them about opportunities. I think we've proven through our engagement with RX that we'll take any bona fide bid seriously. And, maybe just to go back to the price that the approach was at, I think it was at £5.30. Certain independent analysts, and I'm thinking of Berenberg in particular, were of the view that, maybe if there was a 10% bump on that, they might see that as a clearing price. We never got the opportunity to share that with our shareholders, see if they also were of that view. But I think the one thing that was interesting was that nobody threw us out the door for treating the approach seriously. We were trading at around £3 before an approach at £5.30. You certainly have to take it seriously if the people are serious. And the RX team are serious. And, Michael Carville, my predecessor who ran the company for 38 years, he's probably forgotten more about the company than I'll ever know. So you have to take him seriously too.
Tom, appreciate that. That's a really interesting introduction to the company from me and probably the listeners and readers and viewers of this. Appreciate your time today. Stay in touch, let us know how you get on. Obviously, busy times, as I say, next 3 months, very, very important the business and for your shareholders. So thank you again. Cheers.
Thanks very much, Archie. Nice to speak to you and to your listeners. Best of luck.